Okay, so I had a couple of people email me saying they weren't quite sure how to do this problem in the My Open Math homework. It is question number 3. So I thought I'd put together a guided example for you guys where I would walk through a problem that's very similar so you guys could kind of see the thought process that goes through this. And this is kind of what I would do in a face-to-face class. So here you go. This is the actual problem, and then this is the problem I put together for example for you guys. And so this one's done on a spreadsheet instead of in My Open Math, but the same exact concept here. And you notice that the spreadsheet is already laid out. It's got your assets, which include cash, accounts receivable, office supplies, office equipment, and building. These are all the things that the company owns. And then you've got liabilities, the things that the company is going to owe, accounts payable and notes payable. And the equity section right now is consisting of common stock and retained earnings. And then I've got these transactions up here, A through L. And it says record the transactions in the company's books using spreadsheet format below. Make sure the accounting equation is in balance when you're finished. And so one of the important things when you're recording each one of these transactions is that your transaction is in balance. In other words, assets are always going to equal liabilities plus equity. That's the basic accounting equation. So every time you record one of these transactions, A through L, you have to make sure that the transaction makes this accounting equation hold true. Assets have to always equal liabilities plus equity. So in every single transaction, that has to be the case. And so let's just dive in to the first one. The first thing I want to also say is that you are recording these transactions as if you are the accountant or the bookkeeper for the company. Don't think of this from your individual point of view. Think of it from the company's point of view and what journal entries or what transactions have to be recorded in the company's records. So the first one, a stockholder invested $45,000 cash and a building with fair market value of $120,000 to the company in exchange for stock. So anytime a shareholder or an owner invests any type of asset, whether it be cash, a building, land, whatever it is, the asset will go on the company's books, and then the company will issue common stock in exchange for those assets. So you'll be affecting this side of the accounting equation and this side of the accounting equation. So in this case, we've got $45,000 worth of cash. Cash is increasing, so that gets entered as a positive amount. We also have a building. Anytime a non-cash asset is put into a business, it gets put on for the fair market value. In this transaction, it tells us the building is worth $120,000, and so again, building is increasing. And when you add those two together, $120,000 plus $45,000, that's a total of $165,000. So in return for those two assets that the person put into the business, the company is going to issue common stock showing ownership in the company to that person, and then they'll become a shareholder or a stockholder of the corporation. And so you can see here that my accounting equation is going to hold true, right? 45 plus 120 is 165, so $165,000 worth of assets that are increasing. No liabilities, but then I also have equity that's increasing of 165,000 in the form of common stock. Okay, so 165,000 equals 165,000. Our accounting equation is in balance. So then we move on to the second one. The company borrowed $20,000 cash from the bank by signing a promissory note that will be paid back over the next 3 years. And so when you go to the bank and you sign that promissory note, they'll give you a check. You'll deposit into your checking account. So in that case, cash is going to be going up. Okay. And the company signed a note. So that'll be notes payable. That's the difference between accounts payable and notes payable. Whenever you see a transaction that says you signed a note, that is always going to be notes payable. Because typically with accounts payable, that's just when you've gone into someplace and you've opened an account with them. It's kind of like a revolving line of credit. But if you ever see a transaction that says you signed a note for something, that is always going to be notes payable. So we're going to owe the bank $20,000. We have to put that liability on our books. And the liability is increasing, right? It's going from 0 to $20,000. So that's going to be also entered as a positive. So again, with this transaction, you can see this side of the accounting equation was affected. My cash went up by $20,000, so assets went up by $20,000, and my liabilities went up by $20,000. So $20,000 equals $20,000. The accounting equation is still in balance. Okay. The C says we purchased office supplies worth $1,500 for cash. So in this case, I'm only affecting this side of the accounting equation, right? Because I've got two assets. I've got computer equipment or office equipment, and I've got, I'm sorry, supplies, not office equipment. I was on the wrong line. Supplies and cash. So my cash is going to be going down because we paid for this with cash. So I have to enter that as a negative amount. So anytime one of these categories is going down, you have to enter it as a negative, even in MyOpenMath. If I just entered $1,500 positive here, MyOpenMath would tell me it's wrong because it's not positive. Cash is not going up, it's going down. So you have to enter that as a negative. And then we purchased office supplies. So our office supplies are an asset. We'll eventually use those, but at first, when we first buy them, they're assets to the company. They sit there and they're ready to be used. They're something that the company owns. And so I have one asset that's going up and one asset that's going down. And so if we look at our accounting equation overall, again, my total assets didn't increase at all, right? Because I had one that went up and one that went down by the same amount. And so in that case, this side of the accounting equation doesn't have to be affected because this side didn't go up, so this side doesn't have to go up. Okay, it's just one asset went up, one asset went down. We exchanged one asset for another. D says I purchased a computer from OfficeMax on account for $1,250. Okay, so that's going to be office equipment. It's a computer. And so I can say my office equipment is going up, right? I purchased that office equipment. So my office equipment is going from $0 to $1,250. And then it says we purchased it, but it says we purchased it on account. So in this case, we're not paying cash for it right now. We've gone into OfficeMax, we've opened up an account, and they're giving us 30 days to pay on that. So again, it's kind of like a revolving line of credit. And so, but again, my accounts payable is going up, right? It was $0 before, and now it's $1,250. I owe OfficeMax that money. So if you look at the accounting equation, my assets went up by $1,250, my liabilities went up by $1,250, so my accounting equation is in balance. E says we provided consulting services to a client on account. So again, it was on account. We didn't collect the money right away. So they're going to owe us this money. So anytime you do a service for a customer and they haven't paid you for the service right then, that's accounts receivable. They owe you the money. We have the right to receive that money sometime in the future. So we're going to give the client 30 days to pay us. So my accounts receivable is going up and my retained earnings is going up because that's where our income is recorded. Okay, common stock is when an investor puts money into the business. Retained earnings is when you've provided a service and that money is going in. All right, now we're on F. It says we paid $1,700 worth of rent for the month. And so again, we're paying money out. So my cash is going down. I have to enter that as a negative. And my expenses, my rent expense is going up, but retained earnings is going down. This is the earnings I'm retaining in the business. So my assets went down and my equity went down. G says I placed an advertisement in the local paper that will run during the current month and paid $260 worth of cash. So again, my cash is going down and I have advertising expense. Whenever you have an expense, your retained earnings goes down. H says paid on our OfficeMax account in full for the computer that was purchased in D. So if you remember back from transaction D, we bought that computer on account. And so in this transaction, all we're doing is we're paying this account off. And so this $1,250 now is going to go back down to $0 because now it says we're paying it off. So my accounts payable is getting reduced. So I have to enter that as a negative. And my cash is going down because I'm writing a check. So again, I have to enter that as a negative. I says the customer billed in transaction E paid $800 on their account. So this is the customer that we provided services on account. They're going to pay us later. Now they're not paying us the whole $3,200. They're only paying us $800. But again, now that accounts receivable is being reduced, right? They're no longer going to owe us $3,200. They're going to owe us $2,400 now because now they paid $800 on their account. And they've paid. So we've got cash coming in. So that's going to increase our cash. So again, we've got one asset decreasing, one asset increasing, and so nothing over here has to be affected. So don't claim that as income again. We already claimed it as income in the form of retained earnings back when we provided the service. When they pay on their account, all you're simply doing is reducing the accounts receivable and collecting the cash. And then J says we provided some consulting services for $450 worth of cash. So anytime we provide a service, that we have to recognize the revenue, and when you recognize revenue, retained earnings goes up. But it says they also paid us right away. We didn't do this one on account. So our cash is going to go up, and our retained earnings is going to go up, because again, retained earnings is where your income will get closed out to. And then K says we declared and paid a cash dividend of $300. And so again, we're paying something out. Anytime it says you paid something, you paid cash for it. And so that's $300. My cash is going down. I enter that as a negative. And retained earnings, my dividends, also come out of retained earnings, just like my expenses. So dividends is cash that you're paying out to your owners. Sometimes that gets done monthly, sometimes it's quarterly, sometimes it's just annually. But anytime dividends get paid out, your retained earnings is reduced. And so that's going to be a negative in your retained earnings column. And then the very last one says at the end of the month, supplies were counted, and it was determined that $850 worth of supplies purchased in transaction C, right? We purchased $1,500 of supplies in transaction C, remained. Hint, you have to calculate how much of the supplies were used during the month. So it says we have $840 left. If we purchase $1,500 and we have $840 left, then we must have used $660, right? If I do a simple calculation right here, $1,500 is what we've purchased, and it says we have $840 left, then I must have used $660. But that should be a negative $660 because my office supplies are going down now. They're no longer $1,500. They should only be $840. So I need to enter that as a negative amount. Okay? And now that we've used those supplies, now they become office supplies expense. And anytime you have an expense, your retained earnings goes down. Okay, so with this retained earnings, anytime you have income where you've done a service for a client or you sold products to a client, your retained earnings is going to go up. Anytime you have a cost that you've incurred for the current accounting period, an expense, that is going to make your retained earnings go down. You should enter those as a negative. And anytime you've paid a dividend to an owner, that's also going to make your retained earnings go down, and you should enter those as a negative. Okay, so then all you have to do is add up the columns, right? So I'm just going to do a formula here, and in my open math, you'll have to actually add these all up by hand on a calculator. So I've got $61,240 of cash at the end of the month. Accounts receivable. This customer didn't pay me in full. They still owe me $2,400, right? We provided a service for $3,200 on account for them. They paid us $800, so they still owe us $2,400. My office supplies, if I add the whole monthly's worth transactions up, I have $840 left, that's exactly what transaction L says. We should have $840 left. We purchased $1,500, and we've used $660. Office equipment, we had bought that computer. And so we have $1,250 for office equipment. The building, the owner put that building in at fair market value of $120,000. Accounts payable, we purchased some stuff on account, but we paid it off during the month. So this is zero. Anytime you see a dash in Excel, that means it's zero. The note payable, we had borrowed that money at the beginning of the month, and we haven't made any payments on it yet, so we still owe $20,000. The common stock, remember the owner had put in $45,000 with cash and $120,000 with the building, so the company issued common stock in exchange, showing the owner's ownership in the business. So that's $165,000. And then retained earnings is going to be made up of any revenue you made during the period, less any expenses, less any dividends. So you'll have to add all those up. So I have $730 worth of earnings. You would excuse that. I'm recording this at my house. The school bus just went by, so forgive that. And so I've got $730 there left over of earnings after I've paid out the dividends and paid all my expenses. And so at the end, when you're done, just add all this up and make sure that your accounting equation is still in balance. So if I add my cash and my accounts receivable, my office supplies, my office equipment, and my building together, I have total assets of $185,730. I add my two liabilities together, right? These are things that the company owes. Accounts payable was 0 and notes payable is $20,000, so my total liabilities are $20,000. And then I add my two equity accounts together, my common stock and my retained earnings, and I get $165,730. This side of the accounting equation, though, I have to add my liabilities and my equity together, and they should equal my total assets. So when I add my total liabilities of $20,000 and my total equity of $165,730, I get $185,730, and you should always make sure that that agrees. If it doesn't, if you get down to the bottom and it doesn't, then you're going to have to go back through your transactions and see where you made your mistake. The first thing I would do is re-add all my columns and make sure I didn't make an addition error. Okay, and then I would add across to make sure I didn't make an addition error when I was totaling up my assets, liabilities, and equity. And if you still don't find your mistake, then you're going to have to go through each one of the transactions and make sure you're keeping your accounting equation in balance. Okay, maybe something was supposed to be a negative and you entered it as a positive, and that will throw you off at the end. But with every single transaction, you have to make sure that your accounting equation is in balance, because if not, you get down to the end, then you're going to be out of balance. Okay, so that's it for this. The difficult part with this is being able to read the transaction and determine what accounts are affected. But the nice thing here is you have all the possibilities laid out in front of you. Okay, just remember that this retained earnings column, anytime you've provided a service or you've sold something, that's going to be income coming into the business, and that increases your retained earnings. Anytime you pay something out that's a cost of a current month, it's going to be an expense, and that's going to decrease your retained earnings. And a dividend that gets paid out to an owner also decreases your retained earnings. So hopefully that helps.